With rising COVID-19 cases, weak macroeconomic cues, but some injection of hope through vaccinations, stock markets have been rather volatile. What should be your strategy to tide over these mid-term volatility and create long-term wealth? Well, Chintan Haria joins us today to help us decode asset allocation for 2021, especially amid the surge of COVID-19 cases. Hi Chintan, thank you so much for joining us on Money9. Help us understand what should be the asset allocation strategy right now. Should one go in for actively managed funds instead of passive investing?
Yeah, I think this debate about active and passive is a second step. The first step is to actually allocate in the right manner between equity, debt, and gold. So I think most investors are advised well and they need advisors. So I think that's the first step. And after you have an advisor who can advise you how much should be equity in your portfolio, how much should be gold, how much should be debt, uh, then the active versus passive debate or active funds versus ETFs come into play. It really doesn't matter whether you invest in active funds or passive funds, but what matters is you invest in equity in the right way, in the right manner. And I think that's where we'll probably take this discussion rather than making it active versus passive, because as long as you are investing in equity, the problem in India is equity investing is something which is not taught, not easily done, and it's something which we have missed out as a country, and now it is starting to grow. So I would believe active and passive both are good, and then we can take it forward from there.
Right, Chintan. So, is there a rule of thumb? Is there a formula to how much equity, how much debt one should have in the portfolio? For somebody who's possibly not initiated yet and does not have a formal advisor giving him suggestions as to what his asset allocation as per his goals in life should be.
Yeah, you I think touched many chords there. One is each individual is different in terms of what their overall risks and how they are positioned in terms of what they make uh, on an ongoing basis, what is their inherited wealth, and what are their goals. And also, it depends on your own risk taking ability as well. If you can sleep well with the volatility of the markets, you can have a higher equity allocation if you are younger. If you're older and you're well settled, you can have a high equity allocation as well. So there is no standard rule or standard format. But I would say, given where India is, given where interest rates are, having a maybe 30% equity, 70% debt is something which can be looked at from a investor perspective who is conservative. I'm sure aggressive investors can have a 50 to 70% equity allocation as well.
Right. And what about asset classes like gold and real estate? They're considered more traditional in nature as compared to investing in equities. Do you give any weightage to such traditional asset allocations as well?
I am sure, given where the equity markets are, given where the bond markets are, that is the debt markets, gold, which has been the reserve of value and store of value for the last 5,000 years, that remains an asset class which is important from an investor perspective. And I would believe, given the valuations which are there for equity and bonds right now, gold should be at least 10 to 15% of an investor's financial portfolio at this juncture. Because when there is a volatility in the global markets because of either interest rates going up or equity valuations getting stretched at some point in the next 12 to 18 months beyond what they are right now, gold will be an asset class which people may find interest in. So if you're already positioned there, you can get an advantage earlier than the others. So gold ETFs, gold fund of funds fit in well from an investor's perspective in the 10 to 15% bracket.
Right. And you mentioned gold ETFs and gold fund of funds. What about sovereign gold bonds? Do you think sovereign gold bonds are also a good medium to invest in for investors who are looking at some long-term stability with their investments?
Yes. So if someone is looking at a buying and holding for an 8-year period for the maturity of the sovereign gold bonds, it is a good investment as well. It is a good form of investments. There are certain restrictions on a per person basis per year, but it is, I think, one of the preferred investment vehicles for gold, along with gold ETFs for HNIs HNIs and retail in the last 1.5 years.
Right. Also, take us through your understanding of diversification beyond the Indian shore. So there are a lot of companies today offering a lot of products available that help investors from India invest in global markets, especially the US. At a time like this, when COVID-19 is surging across the world, does it make sense for Indian investors to park some amount of their corpus overseas?
So over the last 3-4 years, we have seen an increased interest by investors to invest abroad as part of the diversification, and it is nothing wrong in doing that. Just that today, if I see the valuation differentials, U.S. markets are at 200% market cap to GDP versus their previous peak in 2007-8 of 120% market cap to GDP. On that parameter, U.S. is expensive. I would say that pure US investing, and that too in technology, may be something which an investor can still do, but be mindful of the allocation because last 3-4 years they have performed very well. It can be a long-term allocation still, but given the past performance, you have to be careful about how much percentage exposure you take to international funds. If you look at it, we are positive on the Asian region relative to US. We are positive on the emerging market space relative to the developed market space. And so our global advantage fund of fund, which basically picks and allocates into international funds from India investing abroad. There we have a good mix of emerging markets and developed markets and a tilt towards Asia as well. So investors who are looking to invest abroad, I would say that our global advantage fund of fund is something as a vehicle which they may look and explore as a potential because we do not know necessarily which markets do well globally because our understanding of global markets is not always strong. So we've brought out the Global Advantage Fund of Fund as a solution for investors who may not have the time to actually see each market globally which is available, be it developed and emerging.
Right, Chintan. So help us understand the taxation as well as the liquidity aspect of investing globally. How easy is it to liquidate your investments and what are the tax liabilities for an Indian investor who's investing through these global fund of funds?
Sure. So the global fund of funds are taxed as debt funds, which essentially, if you hold them for more than 3 years, you get the benefit of indexation and 20% taxation. So that's capital gains, long-term capital gains taxation, which happens on them. And as far as investors are concerned, in terms of liquidity, much like any other mutual fund, they can invest in them and redeem from them. There would be exit loads, etc. Each different for each fund. But I would say that as an allocation, you keep for more than 3 years. In fact, you can keep it consistent for a longer period because it helps you diversify into international investing and you get exposure to Asian stocks, various European, US stocks as well at different points of time. So, from a taxation perspective, it is debt taxation. And from a liquidity perspective, there is no worry. You can entry and you can redeem and subscribe as per your requirements, subject to there would be exit loads at some point.
Right. And before I let you go, Chintan, yesterday we saw the stock markets were down about 5%. On a day of a crash like that, what should an investor do? Do nothing? Is that the best strategy? Or go ahead and buy aggressively? What should be done at a time when markets start going down?
So I think this question is best answered by potentially what should be in the investor's portfolio as a core. And we firmly believe that dynamic asset allocation funds or the balance advantage fund category is a beautiful fit for investors for the long run because whenever markets fall, they buy. Whenever markets rise based on valuation, they sell a bit. So it's this rebalancing, buying low, selling high, simple philosophy, which ultimately helps investors reach their goal through a journey which is probably much more smoother than a pure investment which they would do on their own in terms of picking and choosing. Because we all know greed and fear affects all of us. How many of us were actually able to invest in the month of March 2020? We all got frozen. But that's where the dynamic asset allocation funds come in handy. They go and invest when the markets are falling down. So I think for better part of investors, if you're worried about investing in a day like yesterday and you do tend to get frozen, invest in dynamic asset allocation funds like balance advantage fund category, and I think they should do the job for you in the long run because none of us have time to actually follow the markets every day on a day-to-day basis. And you mentioned about DIY investors. We see this every 10 years, right? That there is a market euphoria and investors directly want to invest in the markets. And then more often than not, a majority of them end up probably, burning their hands or getting hurt. So I would also caution those investors who are not doing detailed reading and investing in the markets. It looks easy to invest in the markets, but I think with some expertise, it would help them to become better investors. And if for those who do not have time, I think mutual funds are the way to go, and within that, balance advantage fund category would suit the rest.
Right, Chintan Haria, thank you so much for joining us on Money9 on Money Masterclass. That's a wrap. Do go ahead and log on to money9.com for more news and updates. Thanks for watching. Goodbye.